Okay, so this afternoon we're looking at technical indicators, and there are three specific indicators I want us to pay attention to as we run this class. We're looking at the oscillators, indicators called oscillators, and we're looking at the the stochastics, the relative strength index, and the MACD. So I want to open a fresh page so that we can get started. Okay. Now, when you open your MetaTrader platform, this is what you likely see when you get started. But then you can always, edit the screen to whatever choice whatever is your point of interest. So I prefer using this white background, so that's what I use. All right, so like I said, we're looking at the oscillators. Now, to get to the oscillators, come to this section. This is the indicator section on your MetaTrader platform. That button up there will lead us to the indicators. So I'll click on it. Sorry, my system is hanging. Just in a second. All right. So we'll click on that indicator button and we'll see this drop-down menu. Now we have different categories of indicators here. The first one is the trend indicator, but then our focus this afternoon is the oscillators. And you can see the menu under the drop-down menu under the oscillators. We have quite a number of oscillators. But like I said, we're just going to focus on three of them in this webinar this afternoon.
I'm not even watching. I just saw something. I really need to.
So the question really is, what are oscillators? Oscillators are indicators that are used to confirm trend. They are used to confirm trend. They are used to confirm if a trend will be going in the same direction for a long period or better still a short period. But the emphasis here is that we use it to confirm if a trend is going in a direction for a long period. So I'll click the drop-down menu again. And please mute your device as you're joining us. All right, so let's continue. So we'll click the drop-down menu. We'll go to oscillators and we'll start with the first oscillator, which is the stochastic oscillator. And you can see that on my screen. That is where the menu is. I'll click on it and this menu will appear, showing visualization, levels, colors, and parameters. But where we have now the parameters, just leave it at default level. Don't alter anything under the parameters section. So go to the levels. Now under levels, there are two figures here. We have 20 and 80. I'll click on it and we have the stochastic oscillator installed on our screen, just like you're seeing at the moment. And if you come to the extreme corner here, you will see the 70. This is, sorry, 80 rather. So the 80 and the 20, those are the levels we saw earlier on. So what are these levels meant for? They are called the overbought and the oversold levels. Overbought and oversold levels. So what does it mean when price is overbought? We say that price is overbought when price trends up, and gets to a point where it can no longer buy. But rather, instead of buying, price reverses from buying from an uptrend to a downtrend. Price moves in a series of higher highs and higher lows in an uptrend. But then it gets to a point where price gets completely overbought. And instead of buying further, it will not have sufficient strength to buy. But rather, the buyers will weaken while the sellers push the price downwards. So that is what this indicator helps us to identify: overbought levels and oversold levels. So the 80 level is the overbought level, while the 20 level is the oversold level. So when you look at the chart, as you can see at the moment, this is a daily time frame. When price gets to the overbought level, that is the 80, you can see that price reverses from buying to selling. Again, price touched the level 80 here, and it reverses from buying to selling. Again, right here, price is trading and price moved around the 80 zone. And here you can see that price declined from buying to selling. And we can see that on and on and on. Same thing here at 80, at stochastics 80, price reversed from buying to selling. Now, on the other hand, the 20 level is an oversold level, meaning when price gets to sell, it sells to a level that it will no longer sell further, but rather it will reverse from selling to buying. Like you can see in these instances, it reverses from selling to buying. So again, we can go on the screen, on the chart, and look at oversold. We say that the 20 level is the oversold level. 20 or below 20. Let me correct that. 20 or below 20. And we can say that when price got to that 20 level or below 20, it's a reverse from selling to buying. Again, here, price goes to 20 and below 20, and then reversed from selling again to buying. Again, another 20 region, it reversed from selling to buying. Again, we have price hit 20, stochastic 20, it also reversed from selling to buying. So currently, price is trading around the 20 region. So we're expecting possibility of a reversal. Now, I want to sound a stronger note of caution here. I did not say that when price gets to 80, that you should place a sell trade. No, it's just for us to take note that reversal can happen at those points. They are not direct signal points. So I never said when stochastics get to 20, place a buy trade. No, we only use it to note what could happen in the market. You can now use your entry strategy to look for an opportunity to buy or sell. When price gets to 80, look for sell, or when it gets to 20, you look for an opportunity to buy. And this is valid for all time frames, that you can think about: weekly, monthly, daily, 4 hour, 1 hour. But I will advise you are careful with stochastics on lower time frames like 15 minutes, 5 minutes, and 1 minute. I think the lowest you should go should be 1 hour time frame. Lower time frames may not give you the best results you want to get with the stochastics. All right, so that's the stochastics indicator or stochastic oscillator. Now we'll go to the next oscillator, and that will be the relative strength index. Again, we'll come to this section that shows us the indicators, the indicator section. We'll click the drop-down menu, and we'll go over to oscillators, and we'll go to the relative strength index, RSI. So we'll click the RSI, and this menu will appear on the screen. Visualization, always leave the visualization to all-time frame. When you leave it at the all-time frame, it means that this indicator will be shown on all the time frame you have in your screen. Then you go to the levels. Now, for the relative strength index, the levels by default is 30 and 70. However, it's advisable you add 50 to it. So you click on add and type 50 and click OK. Leave the parameters in default setting. So click OK, and you have the relative strength index, already attached to your chart. So now the relative strength index is this blue indicator, is a blue indicator with a blue line. So let's delete the RSI for now. Now for the relative strength index, like I said, there are 3 levels. We have the 70, the 50, and the 30. Now, the relative strength index behaves in a similar manner to the stochastic oscillator, just that we use it slightly in a different way compared to the stochastic oscillator. So for the relative strength index, the 70 level is also the overbought level. For the stochastics, 80 is the overbought. For the RSI, 70 is overbought. For the RSI, 30 is oversold compared to the stochastics where 20 is oversold. Now we have the midpoint, which is the 50. All right. So again, for the relative strength index, 70 is overbought, 30 is oversold, and 50 is the midpoint. So again, just like what we discovered on the stochastic oscillator, for the RSI, whenever price gets to 70, or above 70, we see that price reverses from buying to selling. Again, here price slightly touched the 70, and you can see there is a reversal in price. And again, the 30 is oversold. So whenever you see price, hit RSI 30, then you expect price to reverse, from selling rather to buying. So currently price is around RSI 30. So we expect a possible, bullish movement on the price. So that's how to use the RSI 70 and RSI 30. Now, the third part is the RSI 50, which is the one in the middle. So how do we use this one? Now, whenever the RSI crosses from above 50 to below 50, it signifies an opportunity to sell. It signifies a sell signal. And whenever the RSI crosses from below 50 to above 50, it signifies a buy signal. Again, when it crosses from below 50 to above 50, like in this instance, let me start it all over again. When the RSI crosses from above 50 to below 50, it signifies a sell signal. And you can see that, from the chart from somewhere around here, you can see that there's been a valid bearish movement in price. And on this other hand here, the RSI crossed from below 50 to above 50. And we can see that simultaneously, there was a sharp bullish movement in price. Again, here, RSI crossed from below 50 to above 50. And we can see that price, broke out in a bullish direction from there. And on. Here's a reversal from slightly above 50 to below 50. And that led to a massive bearish breakout. So again, another caution, just like I did for the stochastics, I didn't mention that if RSI get to RSI 70, I didn't say you should sell. It's just to let us know that there's a possibility of a reversal. It's for a possibility of a reversal when it gets overbought, oversold. But the area where you could actually have a defined entry is when RSI crosses from above 50 to below 50. That could be a signal, the right signal to sell. Or from below 50 to above 50, that could actually be a signal, to buy. And the third indicator I want to show us is the MACD, the moving average, convergence, and divergence. Again, we'll come to the indicator menu. We go to oscillators. I will click the MACD, and the indicator will appear in this fashion. So visualization, leave it at default. We're not really changing anything, in this indicator. Just use it at default level. Though I like to add 0 because I want my midpoint to be the 0 level. So I'll click OK, and I will have the MACD. So I want to remove the RSI so that it doesn't confuse us. Now, the MACD does not show you whether whether market is overbought or oversold, unlike what the RSI and the stochastic does. But what it does is this. Now we have a midpoint here, which is the 0. For the MACD, whenever the histogram crosses from above 0 to below 0, it indicates a bearish opportunity in the market. When its histogram crosses from below 0 to above 0, it indicates an opportunity to buy. Again, when the histogram crosses from above 0 to below 0, it indicates an opportunity to sell. When it crosses from below 0 to above 0, it indicates an opportunity to buy. So these are the three indicators, I want to show us this afternoon. And we do use some of them when we trade the market. So we've looked at three indicators, the first being the stochastic oscillator. The second being the relative strength index, which is the RSI. And the third being the MACD, the moving average, convergence, and divergence. All right, so these are the three indicators which I want to show this afternoon. Now, it's often not the best to use each of them independently. They are better used in combination with other indicators. In fact, they're better used as part of a strategy to give you a better result when you trade the market. And they can help you trade profitably. Now, this MACD can often lag more than the others, lagging in the sense that it takes time before it actually reacts to show you what is happening in the market. But on the other side, it's actually one of the best indicators in forex trading because the level of accuracy it gives can be very high. Whenever the market crosses, it indicates that there is a complete reversal in the market. It shows that reversal is complete. So it means that if the market is in an uptrend before, when the when the market crosses from above to below, it indicates that you already have a complete reversal of trend. For example, here you can see, let me use the vertical line tool. When the MACD crosses here, or crossed rather, you can see that there is a continuous downward movement of price afterwards. Yeah, the RSI crossed earlier, but the MACD, the MACD often gives you the last setting, the last setup. But anytime the MACD crosses, you can be assured that price has completely changed direction and is going in the new direction the market, is showing you. So like I said, you can incorporate this into your trading strategy. For me, for my own trading style, I personally use more of the RSI and the MACD. So if your strategies work better with the stochastics, that can also be incorporated. And another thing I want to say about the stochastics is that sometimes the stochastics can be more effective on the higher time frame, compared to what you want to use for your entry price. So let's say, for example, you have a strategy where your entry is on the 1 hour. You may be looking at the stochastics on 4 hour because it can give you an idea of the medium term trend in the market while you use a lower time frame, as entry. When we do multi-time frame analysis, you can actually use this indicator for for your multi-time frame analysis. You can look at maybe the trend on the stochastics. If effectively, what I'm saying is that whenever you have stochastics overbought, we are expecting an opportunity to sell. So if you see the overbought on the time frame like 4 hour, you can go to the lower time frame like 1 hour and use your other strategy to look for entry. Again, if you see your stochastics maybe oversold, on the 4 hour, you may be going to the 1 hour time frame to look at, your entry, and you can trigger your entry if everything aligns with the direction that the stochastic is given. All right, so that will be all for my end this afternoon. If you have a question, you can ask, and I'm right here to answer your questions. So you can either unmute your mic or you can type your question and I'll answer.
Well, I know there is one that the take profit is not as wide as this. I know there is one setting that the take profit is.
Okay, I'm not getting any response to that. If you're joining us for the first time, this is PU Prime, and we're a global brand with our head office in Australia, while we have our physical offices in Nigeria, in Abuja, and in Lagos. Okay, somebody is asking the question, how do you set your first to second take profit? Well, take profit is better depending on how you trade, but you can make use of the Fibonacci tool to do that. How can we apply that on our phones? Okay, so this class we're holding is the desktop version. So maybe we'll have the mobile version for this class so that those who use their phones can also use them on their phones. This class is desktop. Okay, Chuku, I miss the Fibonacci practical training. Can you please teach on how to use it for take profit? Okay, I'll just oblige you on that in a minute. If you want to use a Fibonacci tool to set take profit, for example. All right, so let's look at how to use our Fibonacci tool to set take profit.
Maybe we should try, let's try this trading stuff.
All right, so this is a Euro USD. We have a falling wedge pattern on this instrument. So it means we're looking for an opportunity. I didn't do much analysis. It's not a signal. I'm just trying to teach what this person is asking about. But this is a valid falling wedge pattern. And with a falling wedge, you're actually looking for price to go in the bullish direction. So if you now want to use a Fibonacci tool to set a take profit on this, assuming we are going bullish as what we can see, you click on the Fibonacci tool up here on your MetaTrader on desktop. That's this place I circled. So you click that portion, you add the Fibonacci tool. Because you're looking for price to go bullish, you will drag it from the most recent high to the most recent low. This is the most recent high point. This is the most recent low. We're looking for a reversal into the bullish direction. Now, two ways. You can either wait for your price to break out above the upper trend line, then you take your entry. That's one way. Another way is that you can actually set a pending order using Fibonacci, using the nearest Fibonacci level, which is the Fibonacci 23.6. So in this case, you can actually set a buy stop order on Fibonacci 23.6. And you can set your take profit on any of the Fibonacci levels, 38.2, Fibonacci 50, or Fibonacci 61.8. But setting on that all three means you'll be taking three trades. Sometimes that may not be too healthy for your account. So let's remove the 38.2. But usually you can make use of Fibonacci 50 and 61.8 as your take profit level. And the reason is because these are key levels where many times it's been proven that price reacts when price gets to those levels. So what I mean is this, assuming this goes into a buy trade, like I said, when price gets to Fibonacci 50, two things can happen. Price can either retrace, or reverse completely. We have a retracement. If this is a retracement, it means price can continue. So two things can happen here. Either price gets here at 50, retrace and continue, or reverses completely. So those two levels are always used as take profit levels. So in other words, if you are using your Fibonacci tool to set take profits, you can always use Fibonacci 50 and 61.8, which means in that instance, you are actually setting two trades. But it's not a must for you to set two trades. You can just do one if that works for you. Maybe you set a Fibonacci 50 or 61.8 as a take profit. And don't forget, if you're using a Fibonacci tool, your stop loss is equally very important. And you may use a Fibonacci 0 as your stop loss. And not exactly 0, some pips below Fibonacci 0, at least 5 to 10 pips below Fibonacci 0. So why do we use 5 to 10 pips? Reason is because you may anticipate that price will buy. You may trigger your entry and reverse and try to sell instead. Now, if you use exactly your Fibonacci 0 as your stop loss, it means when price drops to that level, the stop loss is taken out and you lose the trade. But many times it's been found out that when price drops like that, Fibonacci 0, it may take that level as a support level and price may still reverse back up later. So that's why it's not advisable to use your Fibonacci 0 exactly as your stop loss, but some pips below it in anticipation of the price, or the fact that price can still reverse and go in your direction. So I hope I've answered the person that is asking a question on Fibonacci. How to set to take profits, first and second take profits. All right, so if there's no further questions, that'll be the end of today's class. The most important thing is that this information we are bringing to you, make sure you practice it. It will help you a lot as a trader. All right, so we'll see you again in another training session some other time. Take care and bye-bye.